morning, students. Today we are going to discuss about the credit control measures. Credit control is an important function of the central bank. Various methods are employed by the central bank to control the creation of credit by the commercial banks. Qualitative credit control methods are used to control and regulate the flow of credit into particular industries or businesses depending on the economic priorities set by the government. Suppose RBI estimates that the inflationary pressures in India is due to commercial banks loan to speculators and hoarders who have managed to control the supply of inflation sensitive goods and thus have pushed up the price level. It is concluded from the above analysis that quantitative controls are indirect while qualitative controls are direct. Credit control is the primary mechanism available to the central banks to realize the objectives of monetary management. Credit control, there are two types, two instruments we can say. Quantitative credit control measures and qualitative. Quantitative means general. Qualitative means selective. In quantitative, there are three types: bank rate, open market operations, variable cash reserve ratio. Selective credit control or qualitative credit control, there are 6 types: rationing of credit, direct action, moral sanction, publicity, regulation of consumer credit, and marginal requirements. Now we can see the quantitative or general methods. Bank rate. The rate of interest of every central bank is known as bank rate. Or repo rate also we can say. Repo rate means increase bank rate. Bank rate is the rate of interest charged by central bank on loans given to commercial banks. Bank rate is otherwise known as discount rate. At this rate, the central bank rediscounts bills of exchange and government securities held by the commercial banks. For example, if the central bank wants to control credit, it will raise the bank rate. As a result, the deposit rate and other lending rates in the money market will go up. Borrowing will be discouraged and will lead to contraction of credit and vice versa. Therefore, bank rate is raised to control inflation. In the opposite case, lowering the bank rate offsets deflationary tendencies. Open market operations. It refers to buying and selling of government securities and bonds in the open market by the central bank. This is done to influence the cash reserves with commercial banks. Sale by central bank brings flow of money to it from commercial banks, thereby restricting their lending capacities. Such operations affect amount of cash reserves with the commercial banks and their capacity to offer loans. During inflation, central bank sells government securities to commercial banks which lose equivalent amount of cash reserve, thereby affecting their capacity to offer loans. Thus, it is an effective measure to control credit. In this, there are two types: narrow sense and broad sense. In narrow sense, the central bank starts the purchase and sale of government securities in the money market. In broad sense, the central bank purchases and sells not only government securities but also other proper eligible securities like bills and securities of private concerns. When the banks and the private individuals purchase these securities, they have to make payments for these securities to the central bank. Variable reserve ratio. In this, there are two types. Three types we can say: cash reserve ratio, statutory liquidity ratio, and legal reserve ratio. We can see the cash reserve ratio. It is the ratio of bank deposits that a commercial bank is required to keep with the central bank. Remember that every commercial bank is required under law to keep with the central bank a minimum proportion of its deposits as reserve in the form of cash. This is called cash reserve ratio. Statutory liquidity ratio. In addition to cash reserve ratio, there is another measure called SLR, statutory liquidity ratio. This refers to that ratio of banks' total demand and time deposits which every bank is required to keep with itself in liquid assets such as cash and government securities. When RBI wants to contract credit or lending by banks, it increases SLR and thereby reduces credit availability. Legal reserve ratio is that percentage or ratio which banks are legally required to keep in the form of cash with themselves and the central bank. The percentage the banks keep with themselves is called SLR, and what they keep with the central bank is called CRR. Thus, there are two parts of LRR, namely CRR and SLR. That means cash reserve ratio and statutory liquidity ratio. Qualitative or selective method of credit control. The qualitative or the selective credit control mean the regulation and control of the supply of credit among its possible users. The aim of such methods is to channelize the flow of bank credit from speculative and other undesirable purposes to socially desirable and economically useful uses. Important selective credit controls are rationing of credit, direct action, moral sanction, method of publicity, regulation of consumers' credit, and regulating the marginal requirements on security loans. These are the qualitative credit control instruments. First, we can see the rationing of credit. Credit rationing is employed to control and regulate the purpose for which credit is granted by the commercial banks. Credit rationing takes into two forms: variable portfolio ceilings and variable capital assets ratio. Variable portfolio ceilings, wherein central bank fixes ceiling on the aggregate portfolios of the commercial bank. They cannot advance loans beyond this ceiling. Whereas variable capital assets ratio in the central bank fixes in relation to the capital of a commercial bank to its total assets. Direct action. Direct action refers to directives of the central bank to enforce the commercial banks to follow a particular policy. The central bank gives direction to commercial banks in respect lending policies, the purpose for which advances may be made, the margin to be maintained in respect of secured loans. So here, the central bank may refuse to altogether grant discounting facilities to such banks, and it may refuse to sanction further financial accommodation to a bank whose existing borrowing are found to be an excess of its capital and reserve. The central bank may start charging penal rate of interest on money borrowed by a bank beyond the prescribed limit. Moral sanction. Moral sanction implies persuasion and request made by the central bank to the commercial banks to follow the general monetary policy in the context of the current economic situation. Publicity. The central bank publishes weekly or monthly or quarterly statements of the assets and liabilities of the commercial banks for the information of the public. It also publishes statistical data relating to money supply, prices, production, employment, and of capital and money market, etc. Regulation of consumers' credit. Under this instrument, the central bank regulates the use of bank credit by consumers in order to buy durable consumer goods in installments. To achieve this, it adopts two devices: minimum down payment and maximum periods of repayment. Changes in the marginal requirements on security loans. Marginal requirements. This system is mostly followed in USA. Under this system, the Board of Governors of the Federal Reserve System has been given the power to prescribe margin requirements for the purpose of preventing an excessive use of credit for stock exchange speculation. The aim of this method is to prevent excessive use of credit to purchase securities by speculators. The central bank fixes minimum margin requirements on loans for purchasing securities. Suppose the central bank fixes a 30% as margin requirements, then for rupees 1000 worth of security, commercial bank may keep 300 rupees as margin and the remaining rupees 700 may be used for lending purpose. If the central bank wants to curb speculative activities, it will raise the margin requirements. On the other hand, if it wants to expand credit, it reduces the margin requirements. So these are the methods to control the credit. There are two measurements. What are they? Quantitative credit control and qualitative or selective credit control. Continuous we can see in the next class. Thank you, students.